Joseph Trevisani from WorldWideMarkets. Welcome to our webinar today. If you'll give me, I'm sorry we're a little bit late this morning. I had a link problem, but it's been solved with the help of my very brilliant technical staff here. Good thing they're there. Give me 1 minute and we will start. Thank you. Good morning, everyone. This is Joseph Trevisani from WorldWideMarkets. Welcome to our webinar today. The title is, of course, rather ominous. Mine are all ominous. I like ominous. I'm trying to figure out which best to illuminate what we're talking about. Okay, let's start with this one here. Just 1 sec. I'll open it up, and then we'll run with our discussion. We have a kind of a new studio here, as you see, which we're going to be using for my interview shows. This week, I expect to be interviewing Ed Moya on Wednesday at 10 o'clock. No, this week, I'm sorry, Kainia Danal, the very well-known technical analyst and investment advisor here in New York City. Invest Diva is her name. That's her business name. And we will be talking to her this Wednesday at 10 o'clock, so please join us. Okay. Let me just check to make sure that we've got everything up and ordering here. We had to put in a wireless card in my computer because for some reason the network link wasn't working. That's what took the extra time. Let me check on the visuals and the audio. For some reason we've been watching, my house. I'm sure you've heard more than once from me that I've got 8-year-old twin girls, and so we are deep, deep, deep into Harry Potter mania. My wife read them the book. We watched the movies more than once, and now we're listening to the book being read by a great British actor named Jim Dale. So almost every video or audio reference that I mention, Harry Potter comes to mind. So excuse me for that. I do not have any pictures of Harry Potter to put up here today, but it is a fascinating. One of our techs here who fixed my system this morning. She's I don't know how old she is, but she's someplace in her 20s, and she also had a great affinity and affection for these novels because we spoke about it. So it's interesting that we now have a generation all raised on the same culture here in the United States. Pretty interesting. Anyway. Okay, so what do we have here? I started out the write-up for this webinar by one of my favorite market cliches. I love market cliches because they can always be expounded into a view of the markets and how the markets function. That's their purpose. When I started trading, and I'd be asking for, I'm sure you know my history since I've spoken of it before. When I arrived on the Credit Suisse trading desk in my Harris tweed jacket, circa 1990, 1992, whenever it was. Actually, I know when it was, but we'll keep these things discreet, shall we say. I had no clue of anything that was going on about the markets. Okay, wait. Also, let me deal with some. Okay, for those of you who are listening live, if you have any questions or credits or anything you'd like to add, jokes, as I always ask for, please put them to chat and I'll deal with them in due course. I do not mind interrupting the flow to consider different topics. I actually like and prefer audience interaction. So when I showed up on the trading desk in my Harris tweed jacket, I had no clue what the markets were. I could never figure out why they hired me anyway. I think it was because I drove a taxi cab and I managed to convince some of the interviewers, the bankers, that driving a taxi cab, because it was an independent business, I owned my own taxi and had drivers work for me, was a lot like trading. They apparently bought it, so they hired me. But there was not a lot of information available to the new assistants on the desk as to what was going on. You were told a very narrow task: get calls, make sure you're accurate, buy and sell when we tell you to, and that's it. But any sense of the market, of what the market was doing, of the role of the bank and the traders in the market was totally missing. I had no idea. The only thing you would get occasionally from some of the traders being a not particularly, I won't say articulate, but introspective lot, were these cliches about the market: have a view. Another one was, that's the one I used to hear most often, have a view. I had no idea what they meant. My favorite market saying at the time was, this was not from them, this is from somewhere else, but nevertheless, it is one: the market can remain irrational far longer than you can remain liquid. Well, that does get at two very profound truths of markets, all markets: equities, commodities, stocks, currencies, any market you'd like. The ostensible purpose of a market, and let's take the equity market in particular for an example, is to do what? Well, it's to permit a very disparate group of individuals to participate together and thereby come up with a more rational view of company prices, of the economy, of where to invest than any one individual. The market, after all, functions as a type of mass mind. It also suffers from some of the other maladies of mind, such as mass psychosis. But be that as it may. So the market's job is to assess, judge, and produce an answer. Assess information, judge the relative worth and the relative veracity, and produce a price. That's what stocks do. So the phrase, the market can remain irrational far longer than you can remain liquid, points to a very important truth about markets. Their economic role, their economic rationality role, is not necessarily dominant. And it's not necessarily dominant for long periods of time. If I had an oil price here, and we'd show that tremendous spike up to $150, or just short of $150, in late 2007 and 8, actually 6, 7, and 8, you would have to ask, rational or irrational? Well, if you were saying that this price is irrational based on a fundamental analysis of supply and the demand in the oil market, you would have been correct. And how do we know you were correct? Because the price crashed. As soon as the fantasy bubble logic was shown to be false. It crashed like a rock. That was a typical, classic market bubble. No different than the South Sea bubble in the mid-17th century, mid-18th century. No different than the tulip bubble in the two most famous examples in the 17th century in Holland. Your being right at 100 in oil and shorting it, unless you had deep pockets to ride that position, would have cost you a great deal of money. Also at 120, also at 130. 140, you're getting closer to the top, but you didn't know that at the time. All that irrationality of markets could have sent you, if you were, a trader betting on that, would have ended your trading career. Irrationality can exist for long periods, but is it really irrational? It is from one point of view, and it most assuredly is not from another. From an economic deterministic point of view, it's irrational. There was nothing in the world economy and supply and demand for crude oil except for the fantasy of peak oil, which is yet another one of those justifications for irrationality in the markets. There was no justification in any economic equation for oil at $150. No supply problem, no demand problem. There was the fantasy of Chinese demand ever rising, a developing world demand ever rising and ever driving up the price of a declining asset. That was the fantasy of peak oil. What happened? No. Mankind, as it is wont to do, invented a new technology that disposed of peak oil rather handily. And of course, it's shale oil fracking. And the same thing in tar sands in Canada. So the irrationality did not crash, though, because of that. It largely crashed because of the recession and the financial crisis cut the legs out from under any idea that the other side of that, the demand side, there was going to be this ever-increasing demand out of China and the developing world. So as an example, oil, and I'm going to move to stocks in a second. Let me tell you what I have here anyway. This is the level of US GDP, not the quarter-to-quarter change, the absolute level of GDP as in size of the economy. This is the Fed funds rate going back to 1970, when the only chart I could get, and this is the Dow. So we're going to talk about that in relation to what I'm saying here in a second. So what is the way in which the oil market behavior in those years was not irrational? And that, of course, is the behavior of traders chasing profits. As traders, as markets, there is no inherent value in any level except whether it's going to go in one direction or another, and when. Markets perform two jobs. They permit us to find a price level equivalent to what we think are the economic fundamentals behind it, and they also permit us to chase trading profits. And trading profits are incidentally imbued with economic information. Economic information being distinctly different than markets' view of the economy at any one time. Sometimes they're the same, sometimes they're not. It's an ever-changing mix. In the oil example, it was totally disconnected from economic reality, but it was connected to the supply-demand peak oil fantasy, which was dominating traders thinking and driving prices ever higher. Why did traders drive prices ever higher? For a very simple reason. Everybody else was doing it. The trend was very powerful, and everyone was following it. All of the people who would have, in the months and years before that peak, who had tried to short oil because it made no rational sense, which in fact it did not, got poleaxed. The market can remain irrational far longer than you can remain liquid. The market is much bigger and not interested in your particular analysis. So the logic, the trading logic, until of course it crashed, in which case it immediately reversed. And the wonderful thing I like about markets is nobody ever has to say you're sorry. If you are long the oil and you happen to pick the right top and turn around, you're short, nothing has changed. Well, the recession was a bit of a change, I'll give you that. And the financial crisis was a bit of a change, I'll give you that. But you never have to say you're sorry. There's no, that great phrase, I forget where it's from, consistency is the hobgoblin, I think it's Churchill's. Consistency is the hobgoblin of little minds. Well, in the market, you never have to be consistent. You only have to be right to stay on your feet and to make money. So that reversal was a trading reversal. It had nothing to do with, well, when I say it had nothing to do with the fundamentals, of course it did. The reversal and the explosion of the peak oil bubble was predicated on the financial crisis. But the idea that the world economy was going to skate along, the U.S. economy was going to skate along, and all the stuff was going on, was out there. All of the facts that were economic facts that were available before the oil bubble burst are pretty much the same facts that were available after the bubble burst. It's just that the markets looked at them in a different way. Oil is one example of that. Another one, of course, is the in the summer of 2008, the same issue with the ECB and their fantasy and the euro level, which was very high, 1.6, I think, against the dollar, that the European financial system would not have any issue with American subprime crisis. Okay, I think I've told you this before, but not recently. I remember I had friends at the time working on Wall Street and in various securitization positions. And I'd meet them and I'd talk to them. And I would tell them what the international economy was saying. They were really focused on their markets in those days. Trading markets have a way of narrowing your focus very dramatically. And they were telling me, I was telling them that Trichet and the other European bankers were out there saying the European banking system. This was well after the point that it was recognized in the United States that subprime loans were a big problem for American banks. Although, of course, Mr. Bernanke is also out there saying, and sometimes the cluelessness of central bankers actually astonishes me, was out there saying, well, Americans, it's contained. Well, it's not contained. It contained, yeah, if you mean the whole economy. But anyway, after that, when it long since evident that it was a problem for the U.S. banks, Jean-Claude Trichet was out there saying, I wonder if this will be in his Wikipedia page whenever it's, I haven't checked. I wonder if it's there. Maybe I should do an edit and add this little anecdote. Was out there saying, no, we have no problem with the European Central Bank, with the American subprime loans. And I would talk to my friends from downtown. I would tell them what Trichet and was going on in the international markets in Europe. And they would say, what are they talking about? European banks bought tons of this questionable paper. And of course, that turned out to be the accurate assessment of what happened. The European banks were chock full of this paper, which turned out to be, because much of it was in those days mark-to-market, worthless at that time. So that's another fantasy of a market that gets punctured. There are two questions we have here when it comes to the U.S. equity, and actually global equity levels, but I'm just going to focus on the U.S. and the Dow, because you can only tell so many stories in 1 hour. As I wrote in the précis for this, I said the emblematic American Dow Jones Industrial Average has more than tripled in value since its March 2009 bottom. That would be right here. 220% in 8 years, a very respectable 27% per annum. That's a very nice return, you must admit. Those same 8 years saw some of the weakest U.S. economic growth in post-war history. At least the average year-to-year, here I'll show you. The average year-to-year percent change, okay, which is right here. You can see through here that right now we're averaging 1.9%. I do find it interesting, as long as we're on this topic, that the Fed is now positing at least 3 interest rate hikes this year. One does have to make the question, pose the question. Economic growth was 1.9% in the fourth quarter. It's tracking at about 0.9 in the first quarter of this year, and we don't really have a good sense of where it's going to go. We can discount the Fed's, actually in this case, the Fed's percentage predictions might actually be right. I think they're predicting 1.9% for 2017. Suddenly, it's imperative that we raise rates. For 8 years prior to this, under a different administration, the Fed could not bring itself to raise rates. Now that economic growth is no different, it sees that it's imperative to raise rates. So a couple of things are possible here. One is certainly that economic growth does not produce, that low interest rates at this rate do not produce economic growth. And two, they may actually cause problems. The Fed hasn't admitted this, but otherwise, why are we raising rates now? Okay, leave that alone. So we have not had much of a recovery the past 8 years. But what we have had is this. We have a new system here. Okay, hang on. Okay. Nope, not the one I want, sorry. This one, yes, the one I just have. Okay. If we look at the, I have a much more illustrative chart here, and I'll get it to you in a second. A lot of interesting lines here. Green, Fed funds rate. Orange, Dow Jones. Purple, absolute value, not percent change, absolute value, size of the US economy. So what are we seeing? The interesting thing about the slope of the US economy is that it is relatively constant. It steepens a little bit here. And then here, this slope is very similar to this slope back here. So the US economy is growing at essentially within a few percentage points the same rate. The slope back here in the 60s is equivalent here. It's a little less, it's a little steeper here in the, after the the recession in 1982 and in the early 80s and here. So if the equity level, if its essential role, its basic economic role is to mirror, it's not role, but what it depicts as a descriptive level is the growth of the US economy. The main reason, the main economic reason that equity levels rise is because the economy gets bigger. That's the basic reason. So what is it about these charts, which if you look at it from that point of view, think slope, is rather astonishing? It's the change in slope, the acceleration in the equity level. After all, if this slope had continued over to here, the Dow would be somewhere around 12,000. It's almost double that. What happened? Remember, this is a chart going back to the 1950. This slope is right here. And you know what? I have a better chart. Let's put up that chart. Wait a minute. Let me find the great chart. I have a great chart. I better have it here. Ah, yes, this one. Okay. This is illustrative of the point I want to make here. Okay, now there are a lot of lines on here. Let me tell you what the lines are. I did this only back to 70 because that's as far back as I could get the Fed funds rate. So this is what we have here. Purple is the Dow average. Okay? That's the great crash right there in one day. Like, I don't know, what was it, 20% or something? Right, my year in graduate school, I figured, oh, great. The economy's over. I'm going to start looking for a job. Okay, purple is the Dow average. Orange is the Fed funds rate. Okay, those are the only two things that are on this chart. I would have put on the average of the actual economy, but you saw that from the previous graph. So what we're looking for, let me see if I have both of those. I don't think I do. I'm just checking. Oh, that's the same one. I just want to check these the graphs that I brought in this morning. Okay, what's this? That's percent change. No, I didn't put the size on it. So okay, we're gonna have to remember the other chart. Sorry about that. Okay. Whoops. Come on, here we go. Okay, here we go. Okay. What's the most striking thing about this chart from the Dow point of view? It's the change in slope. Look at the change here. These are the slope lines basically over a period of time. And as you can see, over time, from about this point on, you get a dramatic change in the levels of the Dow. Although, as we noted here, let me just show you that other chart. Well, let's do it this way. Let's take a look at the time, the chart we're talking about, okay? Let's note the time, okay? Right about here, somewhere around here, right? This is mid-90s, say 1995. Somewhere around 1995, something happens to the Dow. Up this period here, we get this very gentle increase. Remember, from the chart with shows you the Dow, this chart. Okay, so sometimes around 1995. Okay, let's look at this other chart. $1995, remember from the prior chart. Sometime around 1995, right here. Okay. We could say it's a little earlier, 1985, but well, we could actually with this different chart. So here, 1985, 1995. Okay. We're focusing on 1995 right here. Now, this acceleration from the 80s is an actual growth acceleration. The Dow, this slope, the change from this slope to this slope is during the Reagan administration, when the economic policies of the government did contribute, and we can look at that on the chart here, to an absolute increase in the level of economic growth. So 1995 here is what we're talking about here. So this one is tied to it. The growth in this period, right? This is 1980. You can see the slope here speeds up a bit, okay? But from 1995 on, we can see that this growth period, except for a period here in the late second Clinton administration, you can see from about here to here, growth does accelerate. But the growth slope here is relatively uniform. There's some deviation, improvement here and some here. And here's our great bubble, but it's relatively uniform. But look at the Dow. The Dow goes from this slope to this slope. Let's go back to the other chart. Oops, wrong one. Okay, this chart. So remember, about 1995. Okay, so here we have this is the one I alluded to earlier. This is an upswing in the rate of the Dow. It's based on a real change in the U.S. economy. From here, 95, we notice that with small deviation, there's very little change of growth in the U.S. economy. But look at what the Dow does. This is a slope from the previous period. Suddenly, the slope becomes this. And then the next period of acceleration, the slope is this, and then the slope is this. And then there's just ridiculous slope right here, which is after the Trump election. So what are we seeing here? That the mania, if you will, of the equities has become vastly more pronounced. These three slopes have far more in common. This one, and this one, and this one should actually be a little steeper. This one should be a little steeper. I should have done it there. So these three slopes have far more in common than with each other than with the prior slopes. It's a factor change. So the question is, what caused this? Because we looked at the rate of growth in the U.S. economy. Well, if the rate of growth in the U.S. economy hasn't changed very much, what's at play here? Well, we noted earlier in the preamble, if you will, that the Dow serves two purposes. One is an economic representation, but two is a speculative and trading vehicle. One of those two things changed. And of course, it's my contention that the speculative aspect of the Dow and other markets somehow changed around this inflection point here. That's my thesis. So now, if we accept the thesis, let's look for real reasons as to why this, or if I put it this way, let me put it this way I wrote it. I actually like this right now. If the stock market is a method of discounting future earnings and economic growth, something is surely amiss. One theory has been that global equity lows have promoted by the vast experiment zero rates by the world's central banks, with the implication that once the liquidities are thrown, equities will fall. Okay, let's examine that. Let's examine the first idea, that this change right here, from this slope in the Dow to this slope, remember that line should be a little straighter. What prompted that? Well, what is a lot of active stock trading or other trading done with? I don't mean the internet. Well, it's done with borrowed money. If you can borrow at 3% or 2% or 1%, or 0.5%, or some function of that, something close to that. And then you can invest in the stock market or in oil, which is going up 10, 15, 20% a year, and you overrate your trading abilities, as most of us do. What do you stand to do? Well, you stand to make a lot of money, possibly, potentially. So could it be that the availability of credit becomes the enabler? And this is not a very original or new idea. It gets discounted, but I believe this change here, this pivot, needs to be explained. And it's the most readily available and logical explanation for what we've seen over the past 20 years. And what have we seen? Well, this is more or less the slope of interest rates. It's relatively steady. It hasn't changed. I mean, I could have drawn this one, but this is clearly an artificial. So an artificial point here back in the Volcker days of squeezing out inflation in the first Reagan administration. Here, you note that the up and down the Fed funds rate, the cost of interest, went from here, whichever this was, where's my interest rate? About 10% down to 4% here, from a brief 19 down. So this type of decline in interest rates, rapid and substantive, did not produce a bubble in stocks. Same thing here, didn't do it. Here, this period here did. Here we have again here. All right, look what happens here. Rates come off, stock market goes up, Fed pulls in the reins. Market stabilizes around here, relatively stable. Rates come off again, hard after 9/11. What happens? Stock market booms again. Rates go up. What happens? Market crashes. There are other factors here, as we know. What happens again? Long, low rates, market booms. The correlation seems to have changed something around 1995. I'd say earlier, 1992, 93. And what it appears to be, just empirically from this chart, the Fed has made a great deal of noise speaking about the neutral rate of inflation, the neutral rate of interest rate. The neutral rate is the rate at which monetary policy neither excites nor retards economic growth. Nobody has a clue as to what this is. And whatever it is, it changes all the time. And I think that business cycles are inherent in a capitalist system, regardless, really, of what the Fed does with it, with interest rates. But my conjecture, based on this chart, is that there is a change in market behavior relating to the speculative urge. When the cost of money becomes less than a certain point, it would appear to be around 3% from this chart. Because the first instance of a cycle following a cycle, meaning the equity levels following the interest rate cycle, is here. This comes off, this goes off. This comes off, this goes up. This comes off, this goes up to very high levels. And this slope should not even be spoken about. Markets should not be going straight up. I think we can kind of all agree with that. And the disparity, let me just show that one again. Okay, the disparity between these two charts is something that should give equity traders concern, shall we say. This November, this spike here, especially this one, and this part right here, although you could certainly make the argument from anywhere back in the 1990s that the level of the Dow has very little to do with economic reality and has almost everything to do with, oops, where's my chart? Okay, here we go. Oops, sorry. Okay, here we go. Okay, so the change around here has become more and more pronounced. Now, an important corollary of this, I can't prove that there is an inflection point in the relationship between the availability of credit and the Dow level that changes somewhere around 3% and somewhere around the mid-90s, 20 years, a little more than 20 years ago. But I can observe that from that point on, right here, the excited slope of the Dow becomes much steeper than it had even in the period of greatest, or almost the period of greatest, economic growth post-war. Certainly a great change from the 60s and the 70s was the Reagan boom in 1983 through 1987, right here. Okay, these years here. This slope is not nearly as steep as this slope, or this slope, or this slope. But the economic growth back here was much greater than these periods here, and much more sustained. So another factor is at play. And I'm only observing that the change occurred right here, as the Fed funds rate dropped for the first time since the 70s to 3%. And it has continued since then as the Fed keeps rates low. Now, part of the corollary of this, or one of the corollaries, was been Alan Greenspan's conviction and assertion, unfortunately, that the Fed had tamed the business cycle. Nonsense. What it has done in taming, if you can credit that, the business cycle has excited a market cycle. So put all these things together. And the question is, do markets such as equities revert after a long period of well beyond level growth? Do they revert to the idea of acting as a mirror, or holding up a mirror to the economic life and the economic prospects of the country? After all, the connection is that the economy grows larger, the Dow goes higher because it reflects the health, wealth, and success and economic growth rates of the country. Does it revert to that after however long the period is of bubble mania? It's difficult to look at this chart or the prior chart with the size of the US economy and not come to the conclusion that for 2 decades now, the performance of the Dow as a level has vastly outstripped its reflective quotient on the US economy. These slopes are not the same. These three are the same, more or less. Remember, this one's a little steeper. And these three are the same. And they describe different periods. They describe different interest rate regimens from the US Central Bank, the Fed. So the next question we have to ask as traders, who may actually be long the Dow up here, if the Fed gets rates back to 3% and goes above 3%, we're only at 1% now. This is going to take forever. I'm likely to be, I'd rather not speculate where I'd like to be by the time the Fed gets up. So we'll just leave it alone. So if the Fed brings rates back to 3%, let's just say hypothetically, above 3%, does that mean that this period will then somehow revert back to the slope of the previous above 3% Fed rate and come back down to whatever rate we'd like to put, even give it the most optimistic, this one, back to 12,500, and then assume that slope forward? Now, that's a question I don't have an answer to, but I think it unlikely. I think what has proven to be because after all, after this period here, all right, Fed funds rate went back to, after this initial mid-90s descent to 3%, they went back up to 6% here, to 6.5% here, and to more than 5% here. Yet in none of those periods, as rates were rising, did the Dow, at this one point right here, this is the only point, right? Well, let me correct that, since the charts are obviously showing us something different. The Dow did, at these periods, right here and here, regardless of the reason, as the Fed brought rates above, this has got to be giving the Fed fits, right? As the Fed brought rates back above my supposed 3% quantum threshold here, what did the Dow do? It returned to this historical trend. The historical trend for the Dow, based on from 19 back here. Now you can say that that's a erroneous level, but it is an improvement on here. So the historical trend Dow is here, somewhere along these three lines. So what do we see? That at each period we have here of the Fed bringing rates back above 3%, the Dow went back to the historical trend. And here, same thing. The Fed rate's going up to 5. The Dow, yeah, I grant it, through the financial crisis and everything else, the Dow crashed back to historical trends. So what happens here, say 2019, now, part of the issue here is the absolute level. Right here, we have a rise from 1% to 5%. I think it's a little more than 5%. So that is a 4% rise, right? From 1% to 5% is 4%. So if we go from 0.25, we get to 4.25 right here. The tops of each of these increases is lower. Here, we went from 3 to 6. So this increases 3%, or if you take it to here, it looks like it's 6.5%. So it's this increase here from 92 to 2000, 15 years, 8 years, sorry, is 3.5%. This one is 4. So at the very, if you take that as a standard, then the declining Fed funds line show you that the Fed fund rate gets to about 3 point something percent. Okay. If we take this 4% rise, it gets to, is that what that is? This is 1 to 5, 4%. It gets from 0.2 to 4.25, so maybe a little bit over here. The line, my guess is it gets to right here. Okay, so if this represents the Fed's neutral rate, let's assume that it does. I'm not sure it does or it doesn't, but let's just take that as an assumption. We get the Fed, or just the Fed policy over, 50 years. Okay, so we get the rate back to here. Will the market duplicate the prior behavior? I'm talking about equities. Up here, raise rates, back to the trend. Up here in the panic, below trend, and then back. Will we get the same thing here? But that produces a Dow at 12,500. What would be the likely public, economic, Fed policy, governmental reaction to a market trend Dow? Remember, the US economy isn't growing at 8%. It's not growing at 6%. It's not growing at 4%. It's not even growing at 3%. So the economic justification is very low for Dow at these levels. That's just a fact. You can do what you want with it, but it's simply a fact. Would anyone think that a Dow returning to trend would be viewed by the Fed, the government, and the public as anything but an incredible disaster? I mean, the Fed has to look at this chart and not know what the heck to do. The Fed seems determined to raise rates. The Fed knows that a recession is going to come sooner or later. They always do. Night follows day. Recessions follow growth. If it's not true, then we need to know why, and some of these sheets needs to show us. The Fed has no tools that can really prevent this. So where are the Fed going to take rates? I mean, the Fed is making this argument the neutral rate is probably zero. Well, they better. Because otherwise, the neutral rate is going to be somewhere up here, 3 or 4%. Now, if I take this line from here, which is not something you want to do because that's kind of loony, you still get the Fed funds rate higher than it is. So the question is, when the Fed rate gets close to this area here, close to my theoretical 3% boundary, where the market inhabits the mania, what will be the reaction? Well, nobody knows the future. Although most of the time we in the markets pretend that we do, and we talk about it all the time. Will the Fed, say here, sometime in the middle of this year or next year, the Trump administration's economic policies have a positive, theoretically, have a positive effect. U.S. economic growth reaches 4%. What can we guarantee? I think that the stock market will go higher. So the market, when there is positive news, need not resume this historical trend line. What else do we know? That in times of trouble, when the market is declining, it does. We've seen it twice. Despite the steep speculative ascent, the market resumes trend line. Maybe then it takes off on a bubble again, but it resumes trend line. So if the economy does start growing more strongly than 9%, and the Fed brings rates above 3%, which it seems determined to do, although we don't know the future, and we then hit a crash, we hit a recession, as we will, with the Fed funds rate potentially above the 3% line, again, theoretical, I have no econometrics behind this. If I was an economist, I probably could come up with one. This chart seems very interesting. Will the economy and the Dow crash back to trend? I don't have a conclusive answer for this one. I think for the time being, that if the economy in the US does start growing again, the markets will take that from the point at which they start. Meaning the view forward will not be from trend line. The view forward will be from here, where we are now, about 20,900, I believe. So based on that, you get a strong economy, 22, 24, 25,000 even in the Dow, 30,000 as I remember that one book, the Dow 30,000, becomes a reality, it becomes a possibility. But does it mean that the trend line related to economic growth has been disavowed? And despite this incredible run from here to here in the equities, I will say that that is an unproven thesis. Each time in the past 20 years, that the Dow has rapidly accelerated, I'm going to give it to an excess of liquidity providing speculative funding. It has crashed to trend line or below when the central bank raised rates. Now, both of these crashes here were also related to real world events. But you know what? Real world events will continue to happen. This is 9/11, this financial crisis. But real world events will continue to happen. People will get old, they will die, they will have children. The world will go on as it normally has. And that includes a future crisis of some type or other. So the catalysts were catalyzing a market ready to be catalyzed, to use the word too many times in a few phrases. So although one cannot gainsay the level or prescribe shorting equities as a viable trading method, remember the second part of trading, profits, at least for the period of low interest rates, sub 3 from the Fed, the potential for catastrophic crashes seems to have increased dramatically. These charts look nothing except like the charts from the 20s into the 30s. Okay, folks, I thank everyone for attending. I hope this has been interesting. I actually discovered some of what I was thinking about this as I speak. I remember reading somebody said, you know, I never know what I'm going to think till I have to write about it. I'm not quite there, but I'm going to do some more work on this chart. It'll be up on our site and up on our Facebook page sometime this morning. I thank you all for attending, of course. Please tune in on Wednesday at 10 o'clock for an interview with Kayania Danal. And I hope you all have a great day. I'll put my email up there. If you have any questions or comments, please drop me a line. I'll be glad to answer. Take care, everybody.